Okay, now just a quick talk today. We're going to be introducing some more terminology with options. Now, I know I've referred to these before, but let's give you some definitions. After we get the definitions and take a look at some scenarios with options, we're going to start using them and calculating them in return on investment. Okay, you're going to see that your return on investment dollar wise might be better by buying the actual stock, but your return on investment in calls and puts can be a lot greater percentage wise. Okay, so what is a call option? A call option gives whoever bought the call option the right to buy 100 shares of the underlying security at a predetermined strike price. Okay, and it's when we purchase it, there's an expiration date. Now, the further away the expiration date, the more expensive the option is going to be because that's more time that the stock has to make its move. Now, for every buyer, there's always a seller. So if I have now the right to buy, the seller of the call option has the obligation to sell me the shares at that strike price during that defined period of time. Okay, so just as an example, let's say a stock was trading at 50, and I bought a call option, the right to buy that stock at 55. Okay, now right now it would be out of the money. There would be no interest in me paying $55 a share if the market it was trading at was at 50. It's a lot cheaper in the open market. I just buy it in the open market. But my fear was that I don't have the cash right now, so I can't buy it. I do have the cash to buy an option, but my fear is that this stock is going to double in a very short amount of time. It's going to be at $100 per share in no time. If I bought the call option and the stock makes the move, I have the right to still purchase those shares at $55 per share, no matter how high that stock price trades. If it goes to 200 before the expiration, I still have the right to buy those shares at $55 per share, buy it at 55, quickly sell it in the open market at 100, 200, or whatever it's trading at. Okay. It can be a very useful tool and it doesn't require a lot of cash up front. Each option contract is tied to 100 shares. So you can see that if I can pick up a couple options contracts, I have the potential exposure to a lot of shares. All right, now the same idea is happening for a put option, but a put option is the right to sell. So if I buy a put option, I have the right to sell at a fixed price, okay, of an underlying security. And again, there's going to be a expiration date on the contract. Further away the expiration date, the more I'm going to have to pay for that. So the more expensive it's going to be. But if now, like I think we've just rallied in the market, okay, I think that rally is going to end soon, and we might test the lows from last week, or even possibly go lower, depending on how bad things get. So I would want to buy a put option. Okay. Now, if I buy it at the market, it's more expensive. If I buy it out of the money, it's going to be a little bit cheaper. But maybe if the market goes down a little bit, I'll start to make that money back. But again, it's a little bit of cash up front to get exposure to the downside part of the market. Okay, now we'll go into number detailed examples in later videos, but I'm just trying to give you guys an introduction to what the options can do. Okay, so the put option gives me the right to sell at a fixed price. We're going to negotiate that before we enter into the contract. Now, on the other side of that, somebody sold me the put, or that writer has the obligation to buy 100 shares from me at that predetermined strike price if I exercise the option. So again, that term, I'm going to exercise it if it's in my favor, and the seller is obligated to fill that position. Now, I don't have to exercise the put, I don't have to exercise the call, but if it's in my best interest, I can. And the writer or the seller of the option is obligated to fill that order. Okay, now when we refer to the underlying stock, it's basically if we're talking about Apple, Apple would be the underlying stock I could be buying a call option or a put option against. Okay, so if I thought Apple was going to trade lower right now, let's say it's trading at 255, 260, I think it could be trading down to 240, and and possibly even lower, and I'm a little scared of that. I can buy an out of the money put option, so a few $100s to get me a little security for if Apple goes beyond, like goes down to 200 or 180 or something like that. I have the right to sell at, let's say, a strike price of 240 or 245. Okay, so when we talk about underlying stock, is any call or put option is attached to a either an index or a stock or a commodity, or you name it. So that's the underlying investment, underlying security, or in this case, the underlying stock. Now, at the money means the strike price on my option is the same as the current market trading price. So if Apple was trading at 255 and I had a 255 call on Apple, well, that would be considered at the money. Okay, because there's no benefit from either exercising the option or just buying in the open market. We get the same price. Now, in the money, is going to be different depending on whether I'm looking at a call or a put. If we're talking about a same 255 call on Apple, if Apple trades up to 280, well, the market price is above the strike price. So I can buy it at 255 and sell it in the open market at a much higher price at 280. I buy it 250, 255, sell it at 280. I make my profit right there. So if I own a call and the market price is trading above the strike price, it's considered in the money. Now, if I have that 255 call and Apple trades down to 240, okay? Now, a call is the right to buy. Would it make more sense to buy at 255 or 240? Okay, 255, the strike price is much higher than the 240 market price. So it's better to just not exercise the option and buy the stock in the open market. So that would be considered out of the money when a call's strike price is above the current trading market price. Now we have to flip that whole scenario when we're talking about puts. So I have the right to sell, let's say a 255 strike price of for Apple. I bought a put option at 255, so I have the right to sell at 255. If the market price goes down below that, well, it's better to sell at 255 than the lower price. So the put option would be considered in the money when the market price is below the put option's strike price. Okay. Now, if I have the right to sell at 255 and Apple trades up to 280, well, it would be better. It would make more sense to just sell in the open market at 280 than at the 255. Okay. So in an equity put option, if the market price is above the put value, it's considered out of the money. If the market price is below the put option strike price, it's considered in the money. So below, I have a table of call options on Twitter. So this is a little bit old. I'm not exactly sure what Twitter's trading price is now, but at the time, the market price was about $30 and like 20 cents. Okay, so $30.20. The market price was above the strike prices of these. Okay, so I could call the stock away. Okay, I could buy it at 26 and sell it in the market at $30.20. Okay, so it would make sense to buy here and sell there. It would not make sense to buy at 33 when the market was trading at $30.20. Okay, so these strike prices are considered out of the money, and these strike prices, since they were below the current trading price, were considered in the money. Now we'll explain these, but this was I think bid, ask, and last traded price. Okay. So bid is what you're willing to pay for it, what the highest person listed is willing to pay for it, what the lowest person is willing to pay for it, and what it last traded at. So you can see they're willing to pay, let's say $2.37 for the right to buy at 31. Okay. Now the $2.37 would be multiplied times 100. So you pay $237 for the right to buy at 31 in the future. So this is out of the money. We're going to learn a new vocabulary later in the week called intrinsic and extrinsic values. Okay. So right now there is absolutely no intrinsic value since it's better to buy in the market than it is to exercise the call. So what you're paying for here is volatility and time to expiration. There's no intrinsic value in here. So we'll explain that more in later videos, but I think that's enough to digest for today.